Hello financial fans, welcome back to another stock analysis. Today we'll be covering Alphabet Incorporated, stock ticker GOOG. Alphabet Incorporated is a multinational conglomerate with a diverse range of businesses and investments. As the parent company of Google and several other subsidiary companies, Alphabet primarily operates in the technology sector. It oversees and supports the development of various internet-based services such as search engines, online advertising platforms, and cloud computing solutions. Additionally, Alphabet engages in software development focusing on areas like operating systems with Android, productivity tools with Google Workspace, and artificial intelligence technologies. The company also manufactures and sells hardware products including smartphones with Pixel, smart speakers with Google Home, and other smart home devices. Through its subsidiaries, Alphabet aims to push the boundaries of innovation, research, and development. It invests in cutting-edge technologies and it explores emerging fields such as autonomous vehicles with Waymo, life science with Verily, and urban innovation with Sidewalk Labs. Alphabet is currently sitting at almost a market cap of $1.6 trillion, and in 2022 they generated a revenue of $280.9 billion, and they're the fourth biggest company on earth right now. 58% of their revenue is generated through Google Search, 12% through Google Network, 11% from YouTube, 11% from apps, hardware, and content, and the remaining 8% from Google Cloud. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 20%. That can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $15.4 billion in 2013 to almost $75 billion in 2022. The average EBIT growth during this period was 21.4% on average, which is a 10% deduction in the margin of safety. The margin has stayed flat throughout the last 10 years, going from 27.7% in 2013 to around 26.5% in 2022. The average margin growth is still 0.3%, but this is not enough for a margin of safety increase or deduction, so no change in the margin of safety on this metric. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Alphabet, you can see in the top left corner that their debt position is significantly smaller than their cash position, meaning that they can pay off all of their debt with just using their cash. This indicates a 0% debt to EBITDA ratio because Alphabet has no net debt, which is a 5% deduction in the margin of safety. The return on invested capital for Alphabet is sitting at 27.4%, indicating that the management is very effective at allocating capital, which awards them with yet another 5% deduction in the margin of safety. Looking very good so far for Alphabet. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Alphabet going from 2013 to 2022. The average growth rate in the free cash flow annually during this period was sitting at 23.16%, and I'm projecting expected growth rate in their future free cash flow of 8% over the next 10 years. And with this percentage, we'll determine the future free cash flow for Alphabet and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%, giving us a sum of free cash flow of almost $1.4 trillion. To get an equity value then, we have to add the cash and equivalent and subtract the debt, leaving us with an equity value of almost $1.5 trillion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $246.62, which is almost a 100% upside from the current price. The second model that we'll be using is Graham's revised valuation formula. In this model, we'll take a look at the earnings per share that Alphabet is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory that a company with no growth is always sitting at a PE of 7. Looking at all three metrics, we get a fair value out of this model of $113.68, which is a 8.77% downside from the current price. The next model that we'll be using is the multiple valuation. In this model, we'll take a look at similar companies to Google, take a look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 33.72. All that's left to do then to get a fair value out of this model is to multiply it by the earnings per share, which is for Alphabet sitting at $4.64 a share, giving us a fair value of $156.48, which is a 25.58% upside out of this model. And the last model we'll be using is the mean reversion theory. This model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this is the PE ratio. In this case, I've imported the PE ratio of the past 5 years, and on average it has been sitting at 22.54, while the current PE ratio is sitting at 27.03, indicating that it's currently overvalued on this metric. This gives us a fair value of $103.93, which is a 16.6% downside out of this model. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at a final overview, we've imported the discounted cash flow, range valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $155.18. Margin of safety we've determined earlier using a standard margin of safety of 20%, deducting by 5% for the debt to EBITDA, 10% for the EBIT growth, and 5% for the return on invested capital, leaving us with no margin of safety at all, indicating that the fair value is the same as the average out of all of our models. And with the current price of $124.61, we get an upside of 24.53%, indicating that it's a buy out of our valuation. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.